Hey, this is my channel, Booked Coffee. I hope you're enjoying it. The Only Investment Guide You Will Ever Need by Andrew Tobias. The Big Picture. Not long after this book first appeared in 1978, the US financial tide ebbed. Stock and bond prices hit rock bottom, and so did our national debt. Investing over the next 3 decades, as difficult as it surely seemed at times, was actually deceptively easy as the tide just kept coming in. Now we are in the opposite situation: very low inflation, very low interest rates, and an uncomfortable high national debt, making the years ahead a particular challenge. Understanding that challenge, seeing the big picture, will help you put events and decisions in context. Take a minute to consider that national debt and interest rates, then another minute to consider the good stuff. National debt. In 1980, the national debt, which had peaked at 121% of gross domestic product in 1946 as a consequence of the need to borrow whatever it took to win World War II, had been worked back down to 30%. It's not what we repaid any of it, just that the economy gradually drew to dwarf it. Whether for a family or a business, or in this case, a nation, having a low debt ratio is healthy. It gives you wiggle room if you ever run into trouble like a recession and need to borrow. Indeed, that had long been the big idea that in bad times government should learn into the wind and run deficits, borrowing to boost demand and ease the pain while excess business inventories were gradually worked down, and then, in good times, not borrow much or even run a surplus to build borrowing capacity back up. Yet in the mostly good years since the 1980, our national debt has ballooned from 30% when the Reagan-Bush team took over. It topped 100% in the fiscal year George W. Bush passed it on to his successor. Although the deficit has once again been tamed as of this writing, meaning that the national debt is once again growing more slowly than the economy as a whole, the wiggle room is largely gone. I write in this space 5 years ago, with the unemployment rate hovering just around 10% and home foreclosure rates peaking. We will get through this and emerge more prosperous than ever, but the decade ahead will be more about hunkering down and retooling than about jet skis and champagne. And indeed, the unemployment rate has fallen to 5% as I write this in early 2016. Foreclosures are running at their lowest since 2007, and the stock market is more than double its March 2009 low. So we did get through it. Even so, the nation's infrastructure has been allowed to decay badly. The national debt may require 35 years to shrink back to 30% of GDP, as it gradually did in the 35 years following World War II, and many of the new jobs don't pay nearly as well as the ones they have replaced. So it's still too soon for the champagne. Interest rates. In 1981, Uncle Sam said, "Lend me $1,000 for 2 years and I'll pay you $336 in interest." In early 2016, Uncle Sam was saying, "Lend me that same $1,000 and I'll pay you $20." And people were rushing to take it. So it's a very different world. In 1981, investors willing to take a risk on stocks or long term bonds knew that if inflation didn't spin entirely out of control, interest rates would eventually fall, making the prices of both stocks and bonds rise. In 2016, investors have to understand that whatever may come first, interest rates eventually will rise, making bond prices fall and stocks relatively less attractive as well. None of this is to say stocks can't go up if interest rates do. They absolutely can, if rates don't go too high and sit atop healthy economic growth. But as a general rule, falling rates boost profits and stock prices. And for nearly 35 years, long term interest rates generally were falling, wind beneath the market sails. At this point, if rates were to start falling again in any major way, it would only because economic conditions are terrible, and that's not likely to drive enthusiasm for stocks. So, either way, up or down, we face a bit of a headwind. The good stuff. For all our problems, there is astonishing onrush of technology. People look at the last 50 years of technological progress and they are dazzled, and they think to themselves, the next 50 years may be equally dazzling. Won't that be something? But no, says futurist Ray Kurzweil, they are wrong. Technological progress over the next 50 years will not be equally dazzling. It will be 32 times as dazzling, 32 times as fast, 32 times as great. The implications are both thrilling and scary. Cyber terrorism, don't get me started. There is no guarantee that whether as a nation or a species will keep from hurtling off the rails. That is indeed the central challenge of the century. But if we can manage to keep from blowing it, the implications are amazing. Imagine, for example, a world of nearly free, clean, renewable energy, much as we now have nearly free communications. Nearly free energy would make everything dramatically less expensive, including materials like energy intensive aluminium, allowing most people to enjoy a terrific boost in their standard of living. And that's just energy. The rate of advance in medical technology is another thing, already dazzling, that's likely to speed up with astonishing implications. It's getting from here to there that is the challenge. At best, it will be a bumpy ride, but making sensible economic and financial choices and getting into sensible habits will at the very least tilt the odds in your favor to enjoy as much of the upside as possible while avoiding the pitfalls. Okay, let's get started.